Managing taxes as a digital nomad. What you need to know: digital nomad lifestyle offers unparalleled freedom, allowing you to work from anywhere in the world. However, along with this freedom comes the complexity of managing taxes across multiple jurisdictions. Unlike traditional employees who have their taxes withheld and filed by employers, digital nomads must navigate the often confusing and overlapping tax regulations of their home country and the countries they travel to. Understanding how to manage taxes is critical for maintaining compliance and avoiding financial pitfalls. In this guide, we'll cover the key tax considerations for digital nomads, including tax residency, income reporting, double taxation agreements, and tips for staying compliant. 1. Understanding tax residency. First step in managing taxes as a digital nomad is understanding tax residency. Your tax residency status determines where you are legally required to pay taxes. Most countries consider you a tax resident if you spend a significant amount of time there, typically more than 183 days in a calendar year. However, some countries have different rules for determining tax residency, so it's important to research each country you plan to stay in. If you are considered a tax resident in multiple countries, you may be subject to double taxation. More on that below. To avoid being taxed in several countries, it's important to know where you qualify as a resident and which rules apply. For example, in the United Kingdom, an individual is considered a tax resident if they stay for 183 days or more in the country during a tax year, or if they have other significant TIs such as a home, work, or family. The UK follows a statutory residence test (SRT) that determines tax residency based on the number of days spent and other criteria like TIs to the country. Digital nomads with frequent stays in the UK need to be careful to avoid triggering tax residency unless they are prepared to pay UK taxes on their worldwide income. 2. Reporting global income. As a digital nomad, you are required to report your global income to the tax authorities in your home country or country of tax residency. This means that any income you earn from freelance work, remote employment, or online businesses must be reported, regardless of where the work was done or where your clients are located. For example, if you are a US citizen, you are required to report your global income to the IRS, even if you live and work abroad full-time. The US is one of the few countries that taxes its citizens on their worldwide income, no matter where they reside. However, US citizens may be eligible for the Foreign Earned Income Exclusion (FEI), which allows them to exclude up to a certain amount of foreign earned income from taxation, as long as they meet certain residency or physical presence tests. In the UK, residents are typically taxed on their worldwide income unless they qualify as a non-domiciled resident. A non-domiciled resident can opt for the remittance basis of taxation, which means that they are only taxed on foreign income and gains if they bring them into the UK. This can be an attractive option for digital nomads who meet the criteria and want to avoid being taxed twice on the same income. Similarly, many countries require digital nomads to report their income if they are considered residents, regardless of where the income was earned. 3. Double taxation agreements. One of the biggest challenges digital nomads face is the risk of double taxation, being taxed on the same income in two different countries. Fortunately, many countries have double taxation agreements (DTAs) that prevent individuals from paying taxes twice on the same income. These agreements are in place to help digital nomads and expatriates avoid being taxed both in their home country and in the country where they are temporarily residing. For example, the United Kingdom has DTAs with over 130 countries, including the United States, Canada, and many EU countries. These agreements help digital nomads by determining where income should be taxed, usually based on tax residency status or income type. Under a DTA, a digital nomad may be eligible for tax credits. Your home country may allow you to claim a credit for the taxes you've already paid to the foreign country. Tax exemptions. Your home country may exempt you from paying taxes on income earned abroad if you've already paid taxes in the foreign country. It's essential to check whether your home country has a DTA with the countries you plan to stay in and understand the specific rules outlined in these agreements. You may want to consult a tax professional who specializes in international tax law to help you navigate these complex arrangements. 4. Self-employment taxes. If you're self-employed, such as a freelancer or independent contractor, managing taxes becomes even more complex. Not only are you responsible for income taxes, but you may also be required to pay self-employment taxes in your home country or country of residence. For example, in the US, self-employed individuals are responsible for paying both the employer and employee portions of Social Security and Medicare taxes, which totals around 15.3% of their income. However, if you qualify for the Foreign Earned Income Exclusion FEI, you may be able to reduce your taxable income, but this does not apply to self-employment taxes. In the UK, self-employed digital nomads must report their income to HMRC Her Majesty's Revenue and Customs via a self-assessment tax return. Depending on your income, you will be responsible for paying Class 2 and Class 4 national insurance contributions (NICs), as well as income tax. You must keep track of your earnings and report them annually to avoid penalties. Make sure you understand the self-employment tax obligations of both your home country and the countries you plan to work from to avoid any unexpected tax bills. 5. Tips for staying compliant. Maintaining taxes as a digital nomad can feel overwhelming, but staying compliant is essential for avoiding penalties and ensuring financial security. Here are some tips to help you manage your taxes effectively. Keep detailed records. Track all of your income, expenses, and travel dates. This will help you determine tax residency and prepare your tax returns accurately. Use accounting software. Tools like QuickBooks, Xero, or FreshBooks can simplify your financial management and help you stay organized. Consult a tax professional. Navigating international tax laws can be complex, so consider hiring an accountant or tax advisor who specializes in expat or digital nomad taxes. Stay informed on tax laws. Tax regulations can change frequently, especially for digital nomads. Stay informed on any updates or new tax policies in the countries where you plan to live and work. Conclusion: managing taxes as a digital nomad requires careful planning, knowledge of tax residency rules, and an understanding of global income reporting. By staying informed about your obligations, utilizing tax-saving strategies, and consulting with professionals, you can successfully navigate the complexities of taxation while enjoying the freedom of the digital nomad lifestyle. With proper planning, you can ensure compliance and avoid unexpected tax issues, giving you peace of mind to focus on your work and travels.